Do you seek shelter beforehand or react when it starts to rain? Why is this relatable? Because you need to watch what key players and market movers are planning ahead. Right now, we are seeing a historic put options volume by traders to hedge their portfolio or to profit from the market. It all makes sense when you see history repeating itself with high correlations. So there is potential for a full-blown market plunge. My role is to inform and prepare you for the best and the worst to come. My advice would be to allocate 5 to 10% into buying put options. To protect your downside when your stocks starts to plunge, your profit from your put options will partially or fully offset your loss. Also, continue to hold quality stocks long term and DCA within your means. Plan early and not react. Now back to chart gaps. Did I not mention 90% of gaps will be filled? S&P 500, 4 out of 4 gaps filled. Interestingly, 3 new gaps has now appeared. Apple, Google, 2 out of 2 filled. You need a plan to place the odds on your favor. Alright, continuing from part 1, follow these investment teams to navigate yourself through such tough market periods. So what opportunities lies ahead? Learning from 08 GFC crash and COVID-19 2020, investment grade bonds had performed the best. Similar to equities, bond prices have priced in rapid future interest rate hikes. Today, we have bonds posting negative returns, which is a very rare case in the history of financial markets. On a 60% stocks and 40% bond, we have reached near 08 level low. Is this the bottom? Likely so. A recession is already ongoing and is expected to turn into a crisis going into 2023. A matter of time till the Fed pivots to cease QT and starts QE. We have recently seen the UK Reserve Bank pivoting to QE at the mere mercy of the financial markets. We know an inverted curve generally leads to an recession or crisis within a period of time. What you may not realize is post-inversion, the 2-year yield falls quickly to factor in future rate hikes, which in turn skyrocket bond price. At current level, bonds risk to reward ratio has never been so attractive. Here's a scenario from JP Morgan. Today, we are at 3.8% US 10-year Treasury yield. A potential upside of 19% when rate cuts are done in the near future. If rate hikes continue on, your downside is just 3% or so. Consider entering position into Vanguard short-term corporate bond ETF or iShares 1 to 5 year investment grade corporate bond ETF. Hence, I can safely say fixed income investments now is one of your best capital protection if you are risk averse. Subscribe if I have added value to you. I understand it is expensive to pay premium for put options to protect your downside, and you still don't wish to sell your shares at a loss. I understand. Allow me to introduce you to zero cost collar option strategy. Let's say you own 100 shares of Apple at a cost of $138 each. Step 1. Buy put option at around 138 strike price. Yes, the premium is crazy high at $895. Step 2. Sell call options. Choose a premium close to $895 and is near the strike price of your put options, with the same expiry date, please. Let's put these trades into the scenario test table. If Apple share price ends at $80 or 42% lower from the current share price, you will exercise your $135 put option, which results in $1,000+ lost. On the other hand, your $145 call option will expire worthless, giving you a premium of $885. Net loss of $310 or just 2% of your initial capital, plus if you have received any dividends across the period of time. If Apple price stays flat at $138, your put option will expire worthless, losing the initial premium of $895. Your $145 call option will also expire worthless, earning you $885 free premium, net loss of just $10 plus any dividends you have received across the period. If Apple price ends at $160, your put option will expire worthless, losing the initial premium of $895. But for your $145 call option, you are required to sell your 100 shares of Apple to the buyer at $145, while you also get to keep $895 premium, which results in $1,000+ from there. Total net profit of $690 or 5% of your initial capital, plus any dividends you have received across the period of time. And that's how you outperform the market or generate alpha for your portfolio. Subscribe if I've added value to you. To sum it off, your best bet would be a diversified portfolio of 40% on fixed income and 60% on value or growth stocks, with strong pricing power and risk minimized with zero cost collar strategy. Fourth quarter 2022 is a focus on capital preservation.